Hey everyone, welcome back. Ready to get just a little bit dangerous.
Haha, that's right. Today, we're diving into investing for beginners.
We're talking enough knowledge to be dangerous, not enough to bet the farm on a meme stock.
Exactly. We want you to understand the basics, make smart choices, and watch your money grow.
Because let's face it, just stashing cash under the mattress. Not exactly a winning strategy these days.
Nope, not with inflation eating away at your savings.
Right, it's like my piggy bank's got a leak. So what's the alternative? How do we fight back against inflation and actually make our money work for us?
That's where investing comes in. It's like instead of just saving, you're putting your money into things that have the potential to grow faster than inflation.
Okay, that makes sense. But, and maybe it's just me, but the whole world of investing, it feels kind of like a jungle out there.
It definitely can. Stocks, bonds, mutual funds, it's a lot.
So let's break it down. Let's say you're totally new to this.
Yeah.
What are the basic building blocks of investing?
All right, so you've got your stocks. Owning a stock is like owning a tiny piece of a company.
So if I buy stock in, say, a company that makes those fancy sparkling waters I like.
You become a part owner, you share in their profits, and hopefully the value of your stock goes up.
Okay, so there's potential for some serious growth there, but, and I'm guessing this is where the dangerous part comes in.
All right, there's always risk involved. Companies can go down as well as up, and you could lose some or all of your investment.
Okay, so not quite like those get-rich-quick schemes you see online.
Definitely not. Investing is a long game. But then you got bonds. Now, bonds are a bit different. Think of them as like lending money to a government or a company.
Oh, okay, so it's more about a steady, reliable return.
Exactly. They're generally considered lower risk than stocks. You lend your money, they pay you back with interest, nice and predictable.
Okay, low risk, steady returns. Got it. But there's always a but, isn't there?
Well, the trade-off is that the potential for growth with bonds is usually lower than with stocks.
So it's about finding that balance between risk and reward that you're comfortable with. Now, what about those other things I always hear about mutual funds and ETFs? They seem kind of mysterious.
I get it. They can sound complicated, but they're really not. Basically, they're like baskets of stocks or bonds. Instead of putting all your eggs in one basket, you're investing in a bunch of different companies or bonds all at once.
Ah, so it's all about diversification. Like, don't bet on just one horse in the race. Spread your bets around.
Exactly. And the cool thing about mutual funds and ETFs is that they're managed by professionals.
Okay, so it's like having a personal chef for your investments, but maybe without the fancy price tag.
Exactly. They can be a really good option for beginners who are just starting out.
So let's say I'm convinced I'm ready to dip my toes into the investing pool. Where do I even start?
Well, the first step is to open a brokerage account.
A brokerage account? That sounds intimidating.
It's really not so bad. Think of it like opening a bank account, but instead of holding your cash, it holds your investments. And the great news is there are tons of online platforms that make it super easy to open one.
So no need to dress up in a suit and go meet with a fancy banker.
Nope. You can do it all from your couch in your pajamas if you want. And another thing that's great for beginners is the rise of fractional shares.
Fractional shares, what are those?
So some companies, their stock prices can be pretty high, like thousands of dollars for a single share.
Yeah, that's not exactly pocket change for most of us.
Right. But with fractional shares, you could buy a portion of a share. So even if you only have like $50, you can still invest in some of those bigger companies.
Okay, that makes investing way more accessible. So I've got my brokerage account, I've figured out fractional shares, what's a good strategy? Should I be watching the market every second, trying to buy low and sell high?
That's what we call market timing. And honestly, it's really hard to do, even for professionals. A much better strategy, especially for beginners, is something called dollar cost averaging.
Dollar cost averaging sounds complicated.
It's actually really simple. Instead of trying to time the market perfectly, you invest a set amount of money at regular intervals. Like every month, you invest, say, $100, no matter what the market is doing.
So even if the market is freaking out and everyone's selling their stocks in a panic.
Yep, you just stick to your plan. And the cool thing is, when the market is down, your money buys more shares, and when the market is up, you're buying fewer shares. It all averages out over time.
That sounds way less stressful than trying to outsmart the market.
It really is. And the key takeaway here is that investing is a long game.
Yeah, it's not about getting rich quick.
Exactly. It's about building wealth slowly and steadily over time. Start small, be consistent, and don't be afraid to ask for help along the way.
And on that note, we're just about out of time.
But before we go, I want to leave you with a thought.
Yeah, it's a little something to ponder as you embark on your investing journey.
Exactly. Think about it this way. What do you want your money to achieve for you in the long run?
Your dreams, your goals, your vision for the future. Let that be your guide.
Because when you connect your investments to your personal aspirations, it makes the whole process that much more meaningful. And who knows, you might just surprise yourself with what you can achieve.
Thanks for joining us on this just dangerous enough deep dive into the world of investing. Now go forth and invest wisely, everyone.